All right, let's dig deeper into shares of the fast casual restaurant Cava. That stock soaring, as Jared mentioned, up nearly 100% after its IPO this morning. The Mediterranean chain went public at $22 a share after raising its pricing expectations at the start of the week. For more market reaction on the news, we turn to Tom Hayes, Great Hill Capital chairman and managing member. So, Tom, let's dig into this.
Yeah. Yeah.
I'm sorry, you're going to get a bunch of puns with this one.
I'm with you.
So the appetite is there. Another one, sorry. 2 for 1. But is this just kind of the brand new shiny thing?
Shiny objects we are in need of. It's been a long 18 months. The market's been dead for new IPOs. And I don't know if the buoyant market is better for Cava or Cava is better for the buoyant market. But I can tell you one thing. Those bankers are not going to be laying on a beach in the Hamptons this summer. They're going to be back out on the street doing deals. There's probably a couple dozen waiting to go. There's huge amount of demand, and the old saying go, when the ducks are quacking, feed them, and the ducks are quacking. You're seeing this thing up. There was indication of interest, maybe $19, $20 or earlier this week. It's came out at 22. It's up almost 100%. They're not making any money, but it shows the pent-up demand from 18 months. And now with the Fed probably out of the way, I think risk is back on, and you're seeing it reflected today.
We've broken through one of the tops that we had seen for the markets, for the S&P 500 at least, and we've continued to move higher since the course of the end of May. Does this move that we're watching in Cava today signal that the environment is more favorable for IPOs to finally get into the fray and that it's game on now for more of the deals?
It's absolutely game on. And this is not only going to be good for the markets, this is going to be good for investors. This is going to be good for bank earnings. You know, if you look at the big banks, they've kind of been lethargic, particularly since the mini crisis in March and April, if you remember. Now you've got this whole avenue of income that they haven't had for 18 months. These bankers have been playing a lot of golf. That game is over. They're going to get back to it, and you're going to see deal after deal, you know, whether it's Fuego de Chao, whether it's Shutterstock, many waiting, and I think they're going to get them out as quickly as possible.
Which Fogo would be a re-IPO, if you will.
Exactly.
Almost a, oh my goodness, when they recreate the movies out there again.
Anyway. A sequel, basically.
Yeah. Sequel IPO.
Yeah. But just getting back to Cava, like we talked a little bit about this offline. I mean, and we saw this, the path to profitability. I mean, last year their loss widened. So is this, you know, for Cava itself, so sure the IPO environment now is hot or setting up to be hot. For Cava itself, is this just kind of a flash in the pan?
Well, for the business, it remains to be seen. You have people on two sides of the spectrum. One is this is the next Chipotle, which I'm a little bit skeptical about. The other is it's the next Potbelly, which could be not a good situation. I think it's somewhere in the middle, the truth. I think they're kind of in the sweet spot of healthy, fast, casual, reasonable prices, decent quality food, fresh every single day. So I think overall it was the right thing at the right time. But the name of the game is they control the supply of the stock, right? So you've got this 18 months of demand for stock. The bankers put out a small amount of supply. Everyone wants that supply. They want to get the pops. There's a performance chase now because managers are still in excessive cash. They're underweight the market. So when something like this comes out, everyone wants to get a piece so they can make these quick gains.
I mean, we're talking about a lunch play right now, and I know we got to move on, but we're talking about a lunch play versus a company that you could see go public in ARM as well later on this year, perhaps. So if you kind of compare and contrast someone who's trying to get your lunch dollar or maybe your dinner buck versus a company that quite frankly, has much larger contracts that it could go after in terms of the multi-billion-dollar type of level here.
Yeah, this is a test of the water. I think the bankers wanted to see what is the climate like? Is the market as hot as we think? And what we found out is the market is hotter than we think. An excess amount of demand, a limited amount of supply. It's a perfect combination. You got to stock up 100%. So expect these things to be oversubscribed. Leading into the big one of the year is going to be ARM. That's probably the most important IPO this year.
So let's widen this out a little bit and let's talk about the Fed and the context, the market rallying and the context of the Fed's moves yesterday. I mean, they largely telegraphed what was going to happen. Like we were expecting this skip, if you will, because especially when we see what the dot plot showed, there's no expectations of any rate cuts this year. Is the market getting ahead of itself right now?
No. I think the Fed is actually done. And Nick Timiraos, the Fed whisperer from the Wall Street Journal, actually called Jerome Powell on his bluff yesterday. He said, listen, I see this dot plot's at 5.6%. If you're so hawkish, why didn't you raise today? And Jay Powell said, because projections can change. And what everyone knows about the inflation numbers coming in, the base effects this summer, year on year, the owner's equivalent rent is going to drop off a cliff in the month of July. And the next Fed meeting isn't until July 25th, 26th. So I think they're buying time to confirm that inflation is going to come down to the low threes, headline inflation. And if that's the case, they're going to skip again, and that's going to turn into a pause. They will keep rates elevated. There's no question about it, because they want to keep the economy from getting too hot. But keep in mind, we've got 120% debt to GDP. The last thing you want is deflation. We have to run growth a little hot to inflate our way out of 120% debt to GDP like we did after World War II.
Okay. So does that put you in the cut camp? Because you said remain elevated, but you didn't say
I am surprised. You surprised me with that.
You didn't say until when, Tom?
Yeah. I think a good analog for thinking about this would be 1995. So they did do one or two cuts. I'm not in the cut camp. I think they're going to hold it at this level as long as they can. Yeah. But the Fed funds rate stayed between 5 and 6% from 1995 all the way till 2000. So they were able to keep rates elevated, and the economy was able to grow above trend. And I think that's the formula they're looking for this time. Little bit above trend inflation, definitely above trend nominal growth. We need that growth to bring down debt to GDP. And I think all the pieces are coming together.
I am surprised by your call. I mean, I'm still in a state of shock. Also, going back to the 90s, I'm like, you don't look old enough to reflect on the 90s. I'm technically old, but I wasn't paying attention enough to that. So again, I'm surprised by this call. And then, so you're saying that the market is not getting ahead of itself, that it's just it's game on in terms of market action now?
I think it's game on in terms of market action. We're seeing pockets of some stocks that are overbought, some indicators that are overbought. You could see a little bit of chop, but I think as far as the IPO game, I think you're going to see a lot of supply in the next few months, and you're going to see it quickly.